there's going to be so much noise over the next 60 days.
Yeah.
I mean, an enormous amount of noise.
Yeah.
Fed, election, strike. I mean,
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters. Today I'm with Lee Mackey
good morning.
and John Martfeld.
Hello.
And got a few things we want to jump into today. Big news of the last day or two leading into this potential strike that is now an official strike.
Yeah.
I think it was at midnight last night.
Mm-hmm.
So this is a pretty big deal with the ports, I think primarily on the East Coast and
the Gulf.
The Gulf.
Yeah.
There was a bunch of numbers out that I was looking at yesterday in terms of like the billions of dollars of goods. I think it was something like 2.7 billion was like coming in just between now and Friday or something like that. No, I mean it's
crazy.
It's crazy how much stuff we take in at these ports and the importance of the supply chains and the flow of goods in and those things continuing. So like any strike, it's always kind of there's two sides to the story, for sure. Typically, reality lies somewhere in the middle. I saw yesterday where it said, and I don't know the truth behind this, obviously, this is just reports, but said that the companies came out and offered like something like 50% wage increases.
Last night they did.
Yeah. And they're like, nope, not good enough. So I don't know what they're wanting. I
know-
don't know if
The two biggest things I heard this morning or yesterday was, from a pay standpoint, they wanted more than the 32% increase that the West Coast port workers got a few years ago, and they want a limit on the amount of automation.
I did
with
see a bunch of
cranes.
signs that said like,
Yeah,
hey,
cranes, cars, and basically they want to ensure that their jobs are not going to be replaced. I saw a report this morning that if it stretches on for several days, it could cost the economy about $2 billion a day in goods that are being held up here. Good news for all of those children that are listening is that most of the major retailers in the U.S. saw it coming. This has not been a surprise, and most of the major retailers have all of their Christmas stock sitting in distribution centers ready to go out. It will affect food.
Yeah, food I think is the big issue. The cost of food.
I've heard also.
that's exactly what we need is higher food prices.
No doubt.
Correct.
No doubt.
I mean, but they're saying that it could come if it stretches on, and then car parts. If you're taking if you have a repair that your car needs to undergo,
Should have got it done.
should have got it done because a lot of those will be held up. But it's a big deal everywhere from Texas all the way around, all the way up to Maine.
Yeah.
So.
It will affect our economy, and it's sad because the offer that they offered them to me, like I'm not on the docks, I have no idea, but the offer seemed pretty awesome, right? I mean,
on the surface, not knowing anything of the underlying, you see that headline number, and you're just like, okay, surely we can get there.
Yeah,
there may be way more to it.
There always is. But I always think about sometimes the unions, like they started in the 30s, they were needed in America and so on. But I get less and less thrilled about them as we go forward. And sometimes I think the fat cats up top that make the decision. I'm thinking if you're a dock worker and you're now not working and you were just offered a 50% pay raise, the pressure from inside the union might start to mount as well to get something done, because they want to work and make money as well.
Sure.
And if they get that big offer, so it'll eventually work itself out. Both sides will figure it out, but it's going to stink for the food and car thing. This
is one that needs to be settled sooner than later.
Yeah, I've heard week to 2 weeks, and after that, then it gets real dicey. Because you don't get a ship over from the Far East in a couple days. I mean, it's weeks,
and it's not like you can hire. Not lack of a better term, but scabs. Like we had NFL strike. We had that in the 80s, but you can't. These things are big, heavy crane stuff. There's important jobs there that are hard, you have to know what you're doing to do.
Yeah, it'll be interesting.
Yeah. Well, the markets and the economy will will be impacted.
Absolutely.
Especially
For
if this drags on for any length of time whatsoever.
Yep.
So that was kind of the headline news that we wanted to just touch on. And we'll be sure to mention more as more comes out. So one thing I wanted to talk about today was how it's really hard to stay bullish as an investor. And what I mean by that is human nature, right? It's easy to be fearful and let simple thought or fear kind of grow and turn into, where we're taking action.
Right.
And we're making we're reacting to thoughts or anxieties or fears that we kind of have within us based on a bunch of hypothetical outcomes and situations. And a lot of people let that drive their decision-making process. And so as much crap that goes on in the world today and as much volatility as there is in markets and geopolitical issues and everything that's involved with, the complexity of our global economy, it's really easy to get bearish, from time to time and be like, things don't look good. And it's really hard to stay the course and remain bullish. And I don't mean by remaining bullish, I don't mean that you think it's just going to go up and to the right all the time.
Yeah.
But where you think, hey, the long term is still going to work out. And I think it's good, one, to acknowledge that and know, okay, it's hard to be bullish because we've all seen this. We've all probably either done it ourselves or definitely have seen it with clients where it feels good to just do something, right? And so you have fear that sets in. You have some anxiety that sets in. You're like, should I do something? And you talk to an advisor, or you talk to a buddy, or you talk to whoever, and they're like, yeah, maybe you should just, it's not worth stressing about it, which it's not, but maybe you should just do something. And they're like, I think you're right. And they get out of the market, or they get a lot more conservative when they don't necessarily need to. And it just feels good. It feels like the right decision in that moment because you're like, I did something.
Yeah.
And it's rarely the right decision over the long term. So what are y'all's thoughts on just remaining bullish and how hard that can be when there's so much going on?
Well, I'm going to go back to 2008. 2008, there was a lot of beginning of 2008, the market was starting to fall, and it was down 10% through spring, and then it was down 20%, it was down 30%, and then the fall hit, and banks started closing, it was down 54% by the time it ended. There are a lot of valuable lessons in there that you learn from experience of that market happening. And one of the things that I learned is a couple things. Number one, it is true. If you were a client, you were invested, and the Dow hit 6,400 on March 7th of 2009, which is where it was at noon on March 7th. I know that for specific reasons, but 6,400.
That's when he cashed everything out.
No, it's not. The Dow today is at 42,000. So you take that and you say, well, yeah, if you would, and it started, by the way, in 2007 at 14,200 was the high, all-time high, fell to 6,400, and now it's at 42,000. So obviously, if you look at it in that perspective, say, okay, well, that's only 16 years ago. We went from 6,400 to 42,500, so we've gone up quite a bit, obviously, about 36,000 points on the Dow. I mean, it's an amazing run, right? And if you miss that, it's emotion got you out of the market at the wrong time, whatever. However, I'm going to go back to that time. There were so many people that were very upset that they rode that down 54%. A lot of them changed. There was a lot of advisors. There's a lot of advisors that got out of work during that time. A lot of people that the turnover rate in our industry was huge because one of the common themes that I heard from clients was the advisor always told me to stay the course, and I lost 54%. They don't realize that 16 years later there would be up tremendously if they just stayed the course. And that's the hardest part about our client relations is going through. It feels like things are going to go down, and I've been on this thing talking about how I think there's some pullback coming, natural pullback coming. It's easy for clients to fear and get in that mode. And then if we as advisors, if we tell them to stay the course and they lose 50%, chances are they're not with us anymore. And this is the point that I always say on the financial planning that we do. When we do a financial plan and the financial plan comes out and says our clients need to make 6% for the rest of their life to make it to age 100 and have all of their goals met, then it's our job to understand that. And if we get into, bad times or what looks like it could be bad times, to make sure that they maintain that ability to make 6%. In other words, it's not that they should all be aggressive in the stock market at that point just because we know long-term the stock market's going to work out. Because we do know that long-term the stock market's going to work out. But I think that if your client only needs to make 6 and they're nervous, to me this is a time to reevaluate and readjust, especially at all-time highs in the market. So I have a little bit of a different feeling just based on what I went through in 2008 and this, and I don't think that we're in line for that type of market downturn. I have some numbers we can go over later about where we think the market will go if corporate tax rates go the Trump way or the Kamala Harris way, and it does matter. Stuff like that does matter. But in the long term, it's about doing the plan right, at getting our clients in the right their risk tolerance model that they are comfortable with, and then coaching them through that when things get tough. And so if you're aggressive, just know you're going to be along for a pretty wild ride. And if you don't need to be aggressive and you're suddenly conservative, we need to coach them through what that means. You don't get to just switch it every day just based on which way the market's going. You should have a consistent outlook what you're doing.
Back to your point, human tendency is for there to be fear, anxiety, worry. You hear the old adage, it can't go up forever. And it can't, and it won't. Emotion, man, so much about this business is emotion. Matt, you were saying earlier about people feel the need just to do something, and they feel like we're not doing our job sometimes if there's not trading going on. And, sometimes the best action is no action.
I would say a majority of the time.
Yeah, and I mean, I preach that to my clients is that sometimes just hitting the pause button is the best action, because what human tendency tells us to do is to sell or buy when it's not the right time. But I tend to be a glass is half full kind of person. I'm probably the exception maybe. But I just think that in this day and age where we're so bombarded with the negative that, I mean, you typically don't see the red breaking news for things that are positive. It's typically something that's somewhat negative.
Fear sells.
Absolutely.
Fear sells, and there's been a ton of people that have made a great living on Wall Street, authors, that just try to stoke fear,
sure,
based on certain things that they think might happen or could go on, and they make a great living along the way,
right,
doing it. And they're just selling fear, and it's harder to sell, hey, things are probably going to be okay. Like I say no one. A lot less people are buying that book. Hey,
right,
everything's probably going to be okay. Than it is like, hey, here's the next big event. Here's what you need to do to avoid it.
Yeah.
Right? Like that's selling millions of copies, and that everything's going to be okay is like, well, okay, but I'm not worried about that.
It's funny. I have a business channel on in my office all day long. Lee, you probably do too, right? Still. I'm listening to the business stuff all day long, and I actually don't think it's negative. I think the majority of the stuff I'm hearing is actually positive. The majority of the news stories are not negative, and the majority of the analysts that come on are telling how things are going to work out. We're going to have a soft landing and everything. I actually hear more positive stories than I do negative at this point. And the reason why I say that, we haven't seen anything negative happen on the market yet. The market is all-time highs. It seems like every week we hit an all-time high. And September's supposed to be a bad month, ended up being a fine month. We hit all-time highs. So I actually think that rhetoric, that fear, now you get it from news, and a lot of our clients are watching the news, and they're watching the election cycle, and they're hearing all these negative things about both sides.
You're watching more the true kind of
I'm watching the business stuff.
channels.
Yeah.
That's your mainstream
so it's
media
protected.
is different. Yeah. Like one of the worst things you can do is watch mainstream media. Mainstream news.
I totally agree.
Not just from a financial perspective.
My happiest clients don't watch the news.
Yeah.
For most people,
It's the truth.
For most people,
Yeah.
default is do nothing, get me out. I mean, it's safe. That is their default. So we, as advisors, that's what we're competing against, is that I want to go and bury it in the backyard mentality. I mean, not really, but
I actually had a client that did do that.
That is the default for a lot of people right now.
Yeah.
And
there's an element of we're kind of rambling at this point, but there's an element of faith that has to be that goes into anything that you're doing, and that includes investing. And that doesn't matter if investing is a CD at the bank or in the stock market. There's an element of faith that, like, hey, things are going to be okay and this is going to work out, because there's risk with everything. You've heard us talk about that. And there are scenarios that things don't work out no matter what you're doing, even if it's buried in the backyard.
Yeah.
Right?
Oh,
so,
no doubt.
Anyways, the markets move and adjust. And I think it's easy to compare historical trends with, hey, this is what we could expect to happen moving forward because this is what's happened in the past. But it's important to remember that the market has changed a lot in the last 20 or 30 years. I was looking at this chart. This is kind of a side note. It's a little off of what we were just talking about. But if you look at the number of U.S. listed stocks, publicly traded companies, back in the late 90s, there's like half as many publicly traded companies today as there were in the late 90s, right? So that's one just market
flushing out
dynamic that has completely changed.
Yeah.
There's far fewer publicly traded companies. That's why you've seen a lot of these products come out that are trying to give you access to private investments, like private credit. Some of these interval funds that they've come out with that, trying to give you access to companies before they go public, because companies just aren't going public as quick. You have companies IPOing at a $50 billion valuation, and that just didn't used to happen. Now I'm just kind of rambling on random things, but it's just an example of that. You can't say, well, this happened at this point in history, and not look at, well, what was the market structure? What was going on? There's a lot that goes into it that may have been why that happened, and maybe the exact reason it's not going to happen this time.
And so much of our clients' thought process at the time is what they are experiencing.
Sure.
We can explain this to them and it might make sense, but what they're bringing to us is their world as they see it right then, whether it's, I've got 3 mouths to feed and I can't afford the groceries, or, whatever. Would you say that your clients, for the most part, are, bullish, bearish, optimistic, pessimistic at this time? What would you say as a general rule?
Majority of mine that have come in are pessimistic.
Yeah.
And it, by the way, it has nothing to do with me. I know you guys think I'm the pessimist here. Here's the deal that I get a lot, and I think this is where clients are. We've had a 16-year run or 15-year run where the market has actually performed very well for 15 years, with a few exceptions like 2022. But the market has done very, very well since 2009. And so there's we're kind of used to that. So when you see little dips in the market, or you start to fear that the market's going to come down, I think expectations for people that are investing are unrealistic. The market doesn't always go up. So, and to the point, what we're saying, like, your emotion has to stay out of it. But I also think we're a little bit spoiled. And so when we do have that next, pullback, whatever, you're going to have more of like, oh, I had this amount of money in my account. Now it's down to this. What happened? What are you guys doing? You guys aren't doing the job right. Right. And I think that's where we as advisors set the expectations based on their risk tolerance, based on their financial plan. And we won't really have those bad conversations if we do that.
But I do think the average investor is so much more educated today than they were 20 years ago.
Agree.
In a good way.
Gosh, I think you're right. You're right, because it's easier to get.
I know I'm right. I wouldn't have said it if I thought I was wrong.
I don't find that with my clients. I find that my clients are, the ones I've dealt with for years are just trusting. A lot of them just trust what I do. They don't want to know what's going on behind the scenes in the market. So yes, Oh, in general, yeah, everybody's got more access to stuff on your phone and whatever, so it's much easier to be more aware. And so yeah, yes, overall, yes. But I do still think there's and especially our older clients that are trusting us to take care of them, don't often, I mean, they're not going out and reading books and watching the news or the business channels and understanding what a stock split means and so on and so forth. A lot of them aren't in that position. I guess I have a lot of older clients too that, I've dealt with for years, but they rely on us a lot. And I think that's where, if we set the expectations right and we do a financial plan and we do all the things right for them, we're not going to have very many problems with clients. Younger clients. So this is something else I always say to like, if you're young and you're listening to this, if you're let's say under 50, or you have more than 10 years until you retire, the volatility doesn't matter, right? It's going to most likely turn out to be higher 10 years from now than it is today. So you can kind of like close your eyes, keep investing, don't worry about it. If you're in a 401k, if you're dollar cost averaging into an investment, it's the best thing you can ask for is volatility. Market goes down, you're buying more shares every paycheck. So, I mean, there's a lot of people that benefit actually from a market, kind of natural movement down, to then pick up the momentum back. So it only affects, in my opinion, the ones that are the most concerned, and the ones we should be most concerned about are the ones close to retirement or in retirement.
Sure.
Where a lot of people in 08, a lot of people that retired, the stories are rampant about how they had to go back and get a job at age 70 because they lost half of their portfolio because it was all invested in the market and it went down 54%.
Yeah.
Yeah.
And that's the kind of stuff we can avoid by helping our clients. So, I mean, I'm fine. I'm a long-term bullish, even though it doesn't seem like it. I do love the market. Been doing it since 1985. So I love the market. But I think there's different sets of people that we, have to treat a little bit differently.
Yeah, for sure. Okay, pivoting off of that, because that was like 5 minutes too long probably. But as we go into the fourth quarter, what do we expect? I know John's got some stuff. Looking back at the third quarter, there's this chart put out by the Compound. Says total returns of the constituents within the S&P 500. So the breadth was incredible in Q3. The average S&P 500 stock return, so the mean return for the 500 individual stocks was 9.2%. The S&P 500 return was 5.4%. So the
for the third quarter.
For the third quarter, the average stock outperformed the index 1.7x. Only 109 of the 500 stocks were negative. And 328 stocks outperformed total return, the index itself. So one of the best third quarters in market history in terms of just market performance. We were overdue a little bit, right? We had these, we talked about it over and over, but we had these 6, 7, 8 names that were just driving the market for so long. And the question was, I remember having the conversation was, are those going to roll over, or is the rest of the market going to catch up?
Yeah.
One of those two things is going to happen. And so far, at least just looking at the third quarter, it's been a little bit more of the rest of the market catching up and not so much of those big names rolling over. So what do we think going into the fourth quarter? We got an election year. We rode through September pretty well. September's usually a pretty rough month in the market. October's also pretty volatile historically. So if we can get through we got through September, if we can get through October, what do we think fourth quarter ends up at? I'm not asking for your S&P 500 price target, but
I got two things.
If the year ended today, we're 3 times what the average is as far as a return.
Right.
I think we've got. I don't know. I think anything over another 3 to 5% would be
gravy.
Yeah. But it wouldn't surprise me if we trade in a 1 to 3% range.
So going back to 1950, in all years where the S&P 500 was up more than 20% through Q3, the average fourth quarter return was positive 2.5%. October was average drawdown of 3.8%. So the average was October, you're going to give some of that back, but then you're going to rally into the end of the year. And that's going back to 1950 for years where the market's up more than 20% through the first 3 quarters.
There's going to be so much noise over the next 60 days.
Yeah.
I mean, an enormous amount of noise.
Yep.
Fed, election, strike. I mean,
Hey, and just something to throw in that, going back to 1950, not one of those years was an election year. So this this one's a little different.
So I'll stay, 1 to 3% above where we're at now by the end of the year.
All right. So I as you guys know, I listen to Brian Westbury from First Trust quite a bit. He's their analyst there, and he uses the corporate or the capitalized profits model to kind of get his estimation where the S&P should be. And he uses that every year, kind of get his projections, and he's been wrong the last 2 years. He's been under. He's
been more conservative.
Yeah, but much more conservative. His little latest thing that I get every Monday, but yesterday's little deal was that the S&P right now he has at 18% overvalued, right? Just using his model. Right. However, he has something in this thing that I thought was pretty interesting. The corporate tax rate, which if it's going to be a dramatic difference between Trump and Kamala Harris. In fact, Trump has said that he would actually reduce the corporate tax rate down to 15% if he were elected. That's one of the things he wants to do. Kamala wants to raise it to 28%. So if they lowered the corporate tax rate to 15% and you took the after-tax profits and you put that into his model, the actual stock market is undervalued. Just think about that for a second. So just his model that he uses could be changed dramatically based on the election results in November. So, I mean, and if she were to be elected, that obviously goes the other way, right? We're even more overvalued, right? But that's his corporate profits model that he's used for years, and I've used it when I was in 08. I mean, it helped me through 08, 09. Has not been right it's not like it's perfect science, no way. But I thought that was interesting that the election.
It's a good point
does matter.
That corporate profits drive the markets, and if you tax those at a higher rate, it's going to impact things.
Impact
for
profits. Sure. And corporate profits really are at the end of the day is all what the markets are about.
Yeah.
I mean that's it.
Yeah.
If corporate profits are good, market's good. And so anyway, there's some little things here like the election that could make a difference at the end of the year. So if you had that happen and Kamala was elected, then you might have selling just knowing the corporate tax rate's going to go up and there's going to be pressure on the economy and if that makes sense. Yeah. So there could be a few things that we don't know yet that could monkey the market.
It'll be interesting.
Yeah, for sure. Okay. Well, good conversation. Couple things. Hopefully the strike, let's cross our fingers and
maybe it's over by next week's podcast.
Be great.
Yeah. Let's hope and pray.
A couple quick things. Next week we have a guest. We've got an analyst from JP Morgan that will be joining us next week. So be sure and tune in for next week's podcast. Also, if you like what you're hearing or seeing, be sure and tell somebody, refer a friend, subscribe. All of those things help us. It lets us know that at least there's one person out there other than my mom that's listening to our podcast. But we enjoy doing it. We hope that some of what we talk about resonates and educates our listeners and viewers.
Yeah, for sure. So, as always, we appreciate you guys listening, and we'll see you next week.